Have you ever seen a property listing and just felt it was too expensive, but couldn't quite put your finger on why? Or worse, have you fallen in love with a home only to realize later you significantly overpaid? Truth is, identifying an overpriced property isn't just about intuition. It's a critical skill that can save you tens, even hundreds of thousands of dollars, and dramatically impact your long-term wealth in real estate. Today, we're going to dive deep into the immediate red flags of an overpriced listing, equipping you with the objective tools to make smarter property decisions right from the start. The problem of overpriced listings isn't just an inconvenience. It's a hidden wealth destroyer. For first-time homebuyers, overpaying means immediately starting with negative equity, making it harder to build wealth or even relocate without financial loss. For property investors, an overpriced asset directly erodes your cash flow, diminishes your return on investment, and ties up capital that could be generating better returns elsewhere. Many buyers, driven by emotion, urgency, or a lack of market knowledge, make the common mistake of accepting an asking price at face value. They overlook crucial data points, failing to understand that a property's list price is often a starting point, not its intrinsic value. This mistake can lead to prolonged holding costs, difficulty refinancing, or even struggling to sell the property down the line without a significant loss. The underlying principle here is that every property transaction involves two parties with potentially different motivations. A seller often aiming for the highest possible price, and a buyer seeking the best possible value. Experienced buyers and investors understand that the listed price is a strategic proposition, not a declaration of inherent worth. They approach every listing with a critical, analytical mindset, understanding that the true value of a property is determined by comparable sales, market conditions, and its potential to generate income or future appreciation, not by the seller's desired outcome. Financial mistake most people make is focusing solely on the "can I afford this monthly payment?" rather than "is this property I worth this price objectively, based on current market data and its future potential?" It's a shift from subjective desire to objective, data-driven assessment. To immediately spot an overpriced listing, you need a structured approach. We call this the three-point overpricing check. First, analyze comparables, comps, and neighborhood context. This is the bedrock. Look at recently sold properties in the last 3-6 months that are highly similar in terms of size, beds, baths, condition, and most critically, location within the same micro-marketing. Don't just look at average prices. Identify the specific price per square foot for comparable properties that have actually closed. If the listing's asking price or price per square foot significantly exceeds these recent sales without a clear exceptional differentiator, like a brand new high-end renovation versus standard finishes, that's your primary red flag. Second, evaluate days on market, DOM, and price reduction history. A property that has been sitting on the market for significantly longer than the local average DOM, especially if it's accompanied by one or more price reductions, is a strong indicator of overpricing. High DOM means the market has already rejected the initial asking price. Sellers often test the waters with an aggressive price, and if it doesn't move, they gradually bring it down. This history is publicly visible on most listing platforms and provides invaluable insight into market reception. Third, assess condition and renovation costs versus price. A property might be listed at a price similar to turnkey homes, but then you arrive to find it needs extensive work. A new roof, HVAC, kitchen update, or bathroom renovations. You must factor in the cost of these necessary improvements. If the as-is asking price plus the estimated renovation costs push the total investment significantly above the value of comparable fully renovated homes, it's overpriced. Experienced buyers always run a post-renovation value calculation to ensure the numbers still make sense. Let's consider Sarah, a first-time homebuyer, looking for a 3-bedroom home. She finds 2 properties, Property A and Property B, both listed around $400,000 in the same general area. D. Dadway. Property A is listed at $400,000. Sarah checks the comps and sees similar homes with similar square footage and condition have sold for $375,000 to $385,000 in the last 2 months. Property also has been on the market for 60 days in a market where the average DOM is 25 days, and it just had a $10,000 price reduction. Furthermore, the listing photos show an older kitchen and bathrooms, suggesting at least $30,000, $50,000 in immediate updates. Using the 3-point check, Sarah quickly identifies property A as overpriced. The asking price is above recent comps. The DOM is high with a price cut, and the condition dictates significant additional investment, pushing its real cost well above comparable renovated property. Property B, also listed at $400,000, aligns perfectly with recent sales of fully updated homes in the immediate vicinity. Its DOM is only 10 days, and it shows no price reduction. Photos reveal a move-in ready home with modern finishes. Sarah realizes that while the initial asking price is the same, Property B offers far better value and is appropriately priced for its condition and market context. The ability to spot an overpriced listing immediately isn't just about saving money today. It's fundamental to building long-term wealth through real estate. When you avoid overpaying, you protect your equity from day one, giving your investment a stronger foundation for appreciation. For investors, this translates directly into healthier cash flow and higher returns, as your capital isn't tied up in an overvalued asset. Over time, consistently acquiring properties at or below market value allows you to build a robust portfolio with significant equity, making refinancing easier, providing more leverage for future investments, and ultimately accelerating your journey towards financial stability and freedom. Every dollar you save by avoiding an overpriced listing is a dollar that can work harder for you, either by reducing your mortgage principal or funding your next strategic investment. Don't let emotion or a lack of objective data dictate your real estate decision. The market offers clues, and with the right framework, you can decode them. By applying the 3-point overpricing check, analyzing comps, scrutinizing days on market and price history, and evaluating condition against renovation costs, you transform from a reactive buyer to a proactive, strategic investor. This skill empowers you to identify true value, negotiate from a position of strength, and build a real estate portfolio that genuinely contributes to your long-term financial goals. Start practicing these checks with every listing you see. Your future wealth depends on it.